It was September 1939. Hitler had just invaded Poland. The world was falling apart. And a 26-year-old analyst picked up the phone and placed the craziest order Wall Street had ever seen. His name was John Templeton. And what he did next would eventually make him one of the greatest investors of the 20th century. Knighted by the Queen. Managing billions. Beating the market for nearly 40 years straight. But in 1939, he was broke. He had to borrow the money. And he used every dollar of it to buy stocks that everyone else was desperate to sell. Today, we're going to unpack exactly how he did it. Because hidden inside Templeton's story is a lesson about human nature that every serious investor needs to understand. And the third principle is the one most people get completely backwards. So picture the scene. The German army is rolling across Europe. Americans are terrified. The stock market is a graveyard. Nobody wants to own anything. Templeton walks into his boss's office and asks to borrow $10,000. In today's money, that's close to $200,000. He had no collateral. Just an idea. He told his broker to buy 100 shares of every single stock on the New York Stock Exchange trading below $1 per share. Every single one. He didn't pick and choose. He didn't analyze. He just bought. The final count, 104 companies. 34 of them were already in bankruptcy. 4 years later, in 1943, he sold the whole basket. His $10,000 had turned into roughly $40,000. Only 4 of those 104 companies went to zero. The rest came roaring back. But here's the part most people miss. Templeton wasn't gambling. He was following a principle he'd already worked out in his head. And that principle became the foundation of his entire career. Templeton had a phrase he used for the rest of his life. He called it the point of maximum pessimism. And he said something every investor should write down and tape to their monitor. The time of maximum pessimism is the best time to buy. The time of maximum optimism is the best time to sell. Now, this sounds simple. Almost cliché. You've probably heard Buffett say something similar: be fearful when others are greedy. But Templeton meant something very specific. He wasn't talking about a correction. He wasn't talking about a bad week. He was talking about the exact moment when investors are convinced, absolutely certain, that things cannot get worse. That's when the prices are lowest. That's when the stories are ugliest. And that's when the future returns are highest. Think about 1939. Hitler in Poland. War about to engulf the planet. Everyone selling. Templeton buying. That's maximum pessimism. The hard part isn't understanding the principle. It's that your brain is wired to do the opposite. When everyone's panicking, you want to panic too. When everyone's euphoric, you want in. Templeton's entire career was about fighting that instinct. And that leads us to the principle that most investors still get wrong today. In 1954, Templeton launched the Templeton Growth Fund. And he did something radical for an American fund manager. He bought stocks outside the United States. In the 1950s, this was almost unheard of. American investors bought American companies. Period. Templeton looked at Japan and saw companies trading at 2, 3, 4 times earnings. In the US, comparable companies were trading at 15, 20 times. So he bought Japan. Heavily. $10,000 invested in the Templeton Growth Fund in 1954 grew to roughly $2 million by the time he sold the firm in 1992. That's about 15% annualized, for nearly 4 decades. He wasn't smarter than everyone else. He just looked where nobody was looking. And this is the part worth slowing down for. Templeton moved to the Bahamas in 1968. Not for taxes alone, though that mattered. He moved because he wanted physical distance from Wall Street. From the noise. From the herd. He said it was easier to think clearly when you weren't surrounded by people who all thought the same way. That's a mindset shift most investors never make. Fast forward to January 2000. The dot-com bubble is at its peak. Pets.com, Webvan. Companies with no earnings trading at hundreds of times revenue. Every analyst on television is saying this time is different. Templeton is 87 years old. Retired from running money for a decade. And he makes one last move. He identifies dozens of internet stocks whose insider lockup periods are about to expire. He shorts 84 of them, betting they'll fall 11 days before the insiders can sell. He made around $86 million on that single trade. He wasn't trying to get rich. He was already rich. He was making a point. Maximum optimism was the best time to sell. Here's what Templeton's life really teaches us. And it has almost nothing to do with stock picking. The market is a mirror. It reflects human emotion back at human beings. When everyone feels the same thing at the same time, that emotion gets priced in. And whoever feels the opposite wins. Templeton didn't have a secret formula. He didn't have insider information. He had the discipline to feel calm when everyone else felt terror. And the discipline to feel cautious when everyone else felt invincible. That's the whole game. You don't need to be the smartest person in the room. You need to be the steadiest. You need to read the headlines, feel what everyone else is feeling, and then ask yourself one question. Is this the point of maximum pessimism or maximum optimism? So I want to hear from you. When was the last time you bought something everyone else was selling? Or sold something everyone else was buying? Drop it in the comments, I read them all. And if Templeton's story changed how you think about market panics, hit subscribe. Tomorrow, we're looking at a company most investors misunderstood for a decade. And why patience made the difference between losing and winning big.